Welcome to This Explainer. Today we're diving into the roller coaster survival guide, understanding market volatility. So let's talk about a universal dread we all share, right? Opening up your investment app, maybe your retirement account, and just seeing an absolute sea of red. It's that terrible stomach-dropping moment where you realize you're strapped into a financial roller coaster that you definitely didn't buy a ticket for. Well, today we're going to unpack exactly what's happening in those moments and, way more importantly, how you can actually survive the ride. Because honestly, ever felt like your portfolio is a literal roller coaster? We've all been there. You check the news, you glance at your phone, and the numbers are just swinging wildly. It feels totally unpredictable. And it's completely normal to feel anxious when your hard-earned money seems to be jumping up and down like that. But what if I told you this unpredictability isn't a sign that the system is broken? It's actually a built-in feature of the market. To stop the panic, we just need to look objectively at what these market swings actually are. Okay, let's dive into this. In financial jargon, that roller coaster effect has a very specific name, and that's market volatility. At its core, volatility is simply the swing or fluctuation in the prices of securities or indices in a specified duration. If you look at it mathematically, it's just the dispersion of an asset's returns away from its average return during a set period. Put super simply, it's just how much the price wanders away from normal. To really wrap our heads around this, we need to contrast two totally different environments. On one side, we've got high volatility. This indicates a high degree of price fluctuation. This is your bumpy, high-speed roller coaster. And because the possible outcomes are so spread out, high volatility points directly to higher risk. On the flip side, we have low volatility. This just means prices remain steady over the given period, giving you a much smoother ride and, consequently, a much lower risk. Now, you might be wondering, how do financial experts actually put a real number on this? Well, they use a mathematical tool called Standard Deviation. Basically, it's a measure of the dispersion of a security's price around its average or mean price for a given period. Think of Standard Deviation as a giant yardstick. It tells us exactly how far those prices are stretching away from the middle ground. So the absolutely crucial takeaway here is this. A higher standard deviation automatically equals higher volatility. When you see a high standard deviation number, it simply translates to a much bumpier ride for you as an investor. The prices are swinging wildly away from their average. So now that we know what volatility actually is and how it's measured, the natural next question is, what pushes the market's panic button? Why does it happen? Because according to the data, these movements aren't random at all. They can be triggered by a whole array of factors, ranging from macro and micro events to politics, economics, and honestly, even just raw human emotion. Starting at the macro level, we have global events. Major international developments create massive global uncertainty, which almost instantly translates to market turbulence. Whether it's hostilities or natural and man-made calamities, the markets always react. We've seen this historically with huge events like the COVID-19 pandemic, shifts in U.S. tariffs, the Russia-Ukraine conflict, and of course, strong market reactions to the ongoing West Asia crisis. When the world is uncertain, the market is uncertain. Let's move on to political and economic factors and see how this builds at the domestic and systemic levels. Things like changes in ruling governments or general political instability can heavily increase uncertainty. On the economic side, factors like increasing inflation, movements in interest rates, or unexpected monetary policy announcements act as direct, immediate signals for prices to shift. These are essentially the big economic levers that can pull a market up or down in an instant. But hey, it's not always grand, global news. Sometimes volatility is triggered by localized market factors. A single company releasing poor corporate earnings, a surprise company-specific announcement, or a sudden development within a specific industry can instantly create localized investor panic. This causes gyrations that might only affect one specific sector of your portfolio, but it can still feel like a pretty sharp drop on that roller coaster. All right, so we've covered the triggers, but understanding the problem is really only half the battle. How do we actually survive it? Well, if market volatility leads to investor panic, we need a concrete strategy to ensure portfolio stability without, pulling our hair out. Get ready, because here is your 3-step action plan to handle these inevitable market swings. Now, what's really interesting about this first defense is how straightforward it is. Step 1, diversification. This is the classic rule of not putting all your eggs in one basket. By spreading your investments across uncorrelated assets, meaning assets that don't move in the exact same direction at the same time, you actively reduce volatility. So a sudden fall in one asset during a market panic can be beautifully balanced out by the steady growth of another asset in your portfolio.
Moving on to step 2, systematic investment, or SIPs. Look, when the market is turbulent, it is incredibly tempting to try and time your buys and sells. Just don't do it. Instead, invest consistently and periodically. By buying a little bit at regular intervals, you're essentially averaging out your purchasing price over the long term. You buy a little when it's high, a little when it's low, and it pretty much completely neutralizes that short-term noise.
And finally, step 3, rebalancing. Because of all those market fluctuations we just talked about, over time your portfolio's allocation is naturally going to drift away from your original plan. By proactively adjusting your asset allocation in tandem with market fluctuations, basically selling a bit of what has grown and buying a bit of what has shrunk, you restore your original intended risk level. This brings stability right back, keeping you on track even when the market tries to push you off course. I really want to highlight this powerful quote straight from the source material. Instead of being distracted by short-term market noise, one should continue to invest for one's goals. Volatility is an absolutely inevitable part of investing. The drops and the spikes, they're going to happen, for sure. But they are just short-term noise, and they should never distract you from the ultimate financial goals you set out to achieve in the first place. Which leaves us with this final, incredibly important question. Will you let short-term noise derail your long-term goals? The roller coaster can definitely be scary, but with a solid understanding of standard deviation, the global triggers of volatility, and a strict adherence to diversification, systematic investing, and rebalancing, you've got the ultimate survival guide. Thank you so much for joining me for this explainer. Stay focused and enjoy the ride.